Stop right there, because the recent action in silver is exactly the sort of surge that reshapes entire markets, wipes out reckless traders, and steadily builds serious wealth for those who stay patient. If you looked away for a moment, you miss the opening blow, but the follow-up is still coming. Silver and gold aren't just rising, they're exploding. The truly astonishing thing isn't the number flashing on your screen, it's what that number reveals about mounting pressure deep within the financial system. At the moment, silver is changing hands near $115 per ounce after briefly hitting around $117 during the sharp rally. Gold is holding firmly above $5,200 per ounce. Platinum and palladium are also drawing strong buying interest. The whole precious metals group is behaving as though a loud warning signal is sounding in the background. One figure quietly backs this up. The dollar index is drifting in the mid-96 range and testing new cycle lows. This is important because metals are always valued in currency terms. Whenever trust in that currency starts to falter, metals don't speak softly, they shout. Still, those elements aren't the primary clue. The real message lies in the market's internal structure. Right now, immediate silver is commanding a higher price than silver scheduled for delivery later. That condition is called backwardation, and it stands out as unusual. Let me explain it plainly, without complicated jargon. Under ordinary conditions, paying for delivery further into the future costs a bit extra. That extra covers storage, insurance, and the cost of money over time. Later delivery normally carries a premium compared with taking possession today. So when the spot price exceeds the futures price, the market is effectively declaring, "I'm willing to pay more to have it in hand right away." Why does that happen? Several possibilities exist, and staying level-headed is essential here. First, it might be a short-lived irregularity driven by funding costs, current trader positions, or technical issues tied to contract rules. Second, it can indicate a genuine extra value placed on immediacy. Actual purchasers want the physical material now, not just a future commitment. Third, it may signal growing concern over whether delivery will occur smoothly. This doesn't mean certain default or dramatic breakdown. It reflects heightened perceived risk. In silver's case, that perceived risk carries extra weight because the overall market is smaller than many realize. It doesn't require massive new buying to create strain in the supply chain. All it takes is demand arriving more quickly than fresh supply can respond. Therefore, when backwardation appears alongside a dramatic jump in volatility, the correct response isn't alarm. The correct response is close observation. Backwardation isn't the headline itself, it's an early warning sign, and warning signs arrive before the full picture becomes clear. Now let's discuss volatility, because this is the factor that emotionally breaks most participants. You witnessed silver shoot higher, then plunge sharply, then recover forcefully. That isn't typical behavior in a calm market. That's the extreme daily swing traders talk about for decades. But here's the common mistake. A big downward candle convinces many the peak has arrived. In genuine bull markets, that belief destroys people. True uptrends don't move smoothly upward. They lash back and forth. They advance, then punish those who chase late. They frighten those who entered early. They draw in borrowed money, then hammer that borrowed money, clearing out fragile positions before resuming the climb. Experienced traders often describe the trend as climbing a wall of worry. That isn't just colorful language, it's a realistic description. The market's single purpose is to move ownership from restless hands to steady hands. Volatility serves as the mechanism to accomplish that transfer. So if your pulse raced during that wild session, well done, you just lived through the rodeo stage of the move. Here's the crucial piece that explains precisely why the violent swings occurred when they did. In the financial, paper market, certain moments create outsized influence. Options reaching expiration, periods when contracts roll over, hedging activity by large dealers, and windows of reduced liquidity. If you've noticed major price action clustering near important deadlines, it isn't always the result of deliberate manipulation. Often, it stems from the mechanical nature of the system. When trading volume thins out, even modest orders can drive exaggerated price changes. When dealers adjust hedges for sizable options exposure, their buying and selling can appear chaotic. When other traders attempt to anticipate and front-run those adjustments, the result is cascading moves. Yes, the action can look orchestrated, but a clearer perspective recognizes aligned incentives combined with market mechanics produce foreseeable turbulence. To counter the most popular online theory, not every sudden drop signals a hidden conspiracy. Sometimes a heavily positioned trade collides with sparse orders. Sometimes risk management teams liquidate to reduce exposure. Sometimes cascading stop-loss orders trigger one another. The outcome feels identical, but understanding the underlying driver is vital. It shapes how you decide to position yourself. Now for the real shocker. The wildest aspect wasn't the percentage swing, it was the sheer scale of value and volume traded in a single session. The paper market effectively exchanged a quantity of silver that would require miners many years to extract from the earth, all in one day. That fact alone reveals where the true contest is taking place. It isn't at the retail coin counter, it's in derivatives, borrowed capital, and the ability to withstand margin demands when prices turn savage. When any market can shift hundreds of billions of dollars in notional value within hours, price itself becomes a powerful instrument. It can force even correct positions to exit. It can set off compulsory selling. It can convince people to abandon metals permanently, just before the advance restarts. This is why the critical question isn't whether the core idea is valid. The critical question is whether you can remain positioned long enough for that idea to deliver results. The advance is merely large, it's rapid. When silver appears to gain hundreds of billions of dollars in market value and then surrender a portion of that gain in the same session, you're no longer watching a quiet commodity. You're watching a market experiencing a fundamental shift in behavior. One consequence is that attention floods in from irrelated areas. Investors focused solely on technology stocks begin discussing metals. People active in cryptocurrency conversations start inquiring about silver basics. That influx creates a self-reinforcing cycle. Fresh capital enters, pushing prices higher. Higher prices attract more attention brings additional capital. Such cycles can persist much longer than doubters anticipate, particularly in a relatively compact market like silver. Yet every cycle has a flip side. While the loop operates, the market grows extremely reactive to small triggers, minor calendar events, settlement dates, significant option levels, positioning data releases, and abrupt drops in available liquidity. That hypersensitivity explains why sharp declines sometimes appear without obvious cause. To preserve your mental balance, avoid fixating on every price fluctuation. Step back and monitor the underlying framework. Right now, that framework continues to indicate persistent tightness. Next, consider what I view as an even stronger clue than the dramatic paper market moves: the elevated premiums in physical markets abroad. Recent data shows physical silver trading in certain major Asian spot markets closing as much as $20 per ounce above comparable U.S. spot levels on the same day. Identical material, identical timing, yet markedly different valuations. Such discrepancies don't arise by chance. They emerge when physical availability and regional requirements fall out of alignment. Even more telling, in some instances, futures prices in those regions have traded below their own spot levels, another appearance of backwardation, this time across different layers of the same market. Whenever spot commands a premium over futures in multiple key locations, it resembles hearing the identical alert echoing from separate parts of the building. Does that guarantee catastrophe? No, but it confirms rising temperature. Does that mean you can arbitrage the difference instantly? Almost certainly not. Practical barriers, transportation, duties, scheduling, regulatory requirements, and everyday supply chain realities are severe. Nevertheless, a continuing premium sends a forceful signal. The market is quietly indicating that the physical reality diverges from the financial, paper reality. Why does that distinction carry weight? Futures allow rolling positions forward. Traders can offset obligations. Plenty of participants never plan to take actual delivery. Physical consumers, however, operate differently. A factory cannot roll its production requirements. A manufacturer cannot net out its material needs. When they require silver, they must obtain silver. Therefore, when physical pricing drifts apart from paper pricing, it exposes an underlying truth. Genuine end-user demand is exerting force that financial flows can no longer fully conceal. Broaden the view further, because silver isn't advancing in isolation. Gold above $5,200 delivers one clear message. Silver outpacing gold delivers another. Together, they indicate the market isn't simply seeking protection, it's seeking scarce resources with amplified momentum. Silver's relative strength typically emerges when participants revalue it beyond its role as a collectible or monetary.
Achieving $500 typically needs one of three catalysts: a major disruption to supply, a policy event that severely undermines currency confidence, or an extremely aggressive speculative rush that compresses future demand into the present. Is it possible? Absolutely. Would it appear rational in real time? Unlikely. It would feel chaotic, and chaos prompts irrational decisions. Focus, therefore, on concrete evidence rather than excitement. Key evidence includes backwardation recurring repeatedly, persistent spreads between Eastern physical levels and Western quoted levels, enormous paper trading volume compared against actual mine output, and the ongoing path of the dollar. Should the dollar continue softening while metals hold firm or advance, the narrative evolves from temporary speculation to deeper structural change. Recent observations show gold maintaining above $5,200 even as the dollar eases, a classic indication of eroding confidence. It implies participants aren't merely following momentum, they're protecting against uncertainty, declining purchasing power, and conflicting policy pressures. Turning to policy developments often overlooked in metals discussions, recent U.S. consumer confidence readings have dropped to unusually low levels. That decline influences consumption, employment, and the central bank's room to maintain restrictive settings. Simultaneously, currency dynamics worldwide are shifting. When major non-dollar currencies gain ground and the dollar retreats, commodities priced in dollars receive an additional lift, not from sudden commodity enthusiasm, but from a diminishing yardstick. Now let's examine retail activity, because this area frequently traps people in overly narrow perspectives. You may hear reports that local dealers see more sellers than buyers, or that certain shops have paused purchases. Those observations can hold true locally in a given week, yet remain irrelevant on a global scale. Local operations rely on upstream suppliers, refiners, and logistics networks. During periods of extreme volatility, those networks experience bottlenecks, wider bid-ask spreads, temporary halts in buyback offers, and distorted inventory patterns. That doesn't signal disappearing demand, it frequently signals infrastructure struggling to price risk without incurring losses. Online platforms often provide a clearer gauge of wider retail trends. Depleted stock levels, extended delivery windows, and unusual premium structures. These reflect genuine purchasing patterns in today's environment. Outside the United States, retail attitudes frequently contradict domestic assumptions. In various Asian regions, precious metals function less as trading vehicles and more as habitual savings instruments. Rising prices, therefore, don't always deter buyers. At times, they reinforce the asset's value and draw additional participants. The central point remains, retail flows are not the dominant force. The dominant forces are industrial requirements and institutional adjustments. That leads directly to the supply side. A frequent reassuring argument claims that higher prices will prompt miners to unleash abundant new production. Reality operates differently. Silver output tends to be inelastic. The majority arises as a secondary product from mining copper, lead, and zinc. You cannot instantly double silver volume simply because its price rises. Achieving meaningful increases demands new exploration, approvals, infrastructure, investment, and, most critically, years of lead time. The market, however, rarely grants that time once momentum builds. Another overlooked factor, even when producers aim to expand, they confront high energy expenses, workforce limitations, and regulatory delays that ignore short-term chart movements. Elevated prices provide motivation, but motivation alone does not flip a switch. Recycling, scrap, also plays a role. Higher values encourage more material from discarded electronics, jewelry, and industrial sources. Scrap supply can relieve pressure temporarily, yet it faces natural limits. It responds to price, it does not solve shortages indefinitely. When slow primary production combined with capped secondary supply, price becomes the primary balancing mechanism. Recent industry reports and development schedules indicate that substantial new output remains years away. Therefore, price must currently perform the rationing function. It curbs excessive demand, encourages substitution wherever feasible, draws forth hidden scrap, and ultimately finances future projects. Until that process completes, tension persists, and that tension is precisely what you sense in the market. Step back further, because silver faces not only a quantity challenge, but also a demand character challenge. Industrial users rarely abandon their requirements when costs rise. They protest, they hedge, they seek efficiency improvements, but the need endures. Investment demand can prove more sentiment-driven, yet it often becomes entrenched once individuals embrace a view on currency vulnerability. These contrasting demand profiles create unpredictable price behavior, particularly under stress. Add the potential for government strategic accumulation. Discussions are increasing around treating certain materials as national security priorities. Silver appears in those talks due to its role in advanced technology, energy systems, and defense applications. Even a modest policy adjustment favoring larger official reserves would introduce a buyer indifferent to short-term price swings. That said, policy discussions often overpromise. Appropriations stall, priorities shift. A complete thesis should rest on observable pressure rather than single rumors. The directional pressure is unmistakable. Demand strengthens across more channels than it weakens, while supply lacks sprint capability. Smart positioning therefore means shifting focus from single sessions to monthly charts. Monthly charts distinguish whether this represents a final speculative blow-off or the early stage of a lasting regime shift. A frequent question arises: does this concern paper silver or physical silver? The distinction matters because ownership experience varies sharply. Paper positions offer speed, you enter and exit quickly, but they concentrate leverage, turning ordinary corrections into devastating losses. Physical ownership moves more deliberately, it carries weight and isn't suited for frequent trading, yet physical metal cannot be conjured electronically. That distinction lies at the heart of the matter. When backwardation emerges, when overseas physical premiums widen, when volatility surges, immediately evaluate which side leads. If physical tightness drives events, paper pricing must eventually align. If paper leads, physical can trail until alignment forces convergence. Without claiming foresight, the typical sequence unfolds as follows. Paper reacts first due to its liquidity and leverage. Rising paper prices then stress physical channels, drawing genuine buyers and prompting precautionary hoarding. Premiums expand as restocking lags. Finally, paper begins responding to evident physical strain, producing the most extreme sessions when financial obligations confront real-world constraints. That final stage creates the legendary price targets people debate. The current phase appears transitional. Paper exhibits classic violent adjustment, yet physical indicators increasingly validate the move. This explains why the story transcends chart speculation. It has become a supply chain narrative, and supply chain narratives rarely resolve gently. If you wonder what ignites a true parabolic phase, it seldom stems from one headline event. It develops through interconnected steps. Certain large buyers withhold inventory, distributors elevate premiums to protect restocking ability, End users pay elevated prices to avoid production halts. Traders recognize paper valuations increasingly depend on unignorable physical demand. Short positions face mounting margin pressure unrelated to fundamental views. At that point, logic yields to pure market mechanics, an unscripted bidding war. One seemingly dull yet vital topic: contract delivery periods. Futures carry calendar tension. As expiration nears, participants must choose: roll, close, or stand for delivery. Most roll over. Even a small uptick in actual delivery requests matters in a tight market like silver. References to particular months aren't folklore. They reflect moments when paper commitments approach physical reality most closely. A slight increase in participants preferring metal over paper alters the equation, causing backwardation to flash on and off like a system alert under load. Another overlooked effect: these price levels disrupt psychology on an institutional scale. Crossing $100 silver forces every quantitative model to recalibrate. Risk officers inquire about exposure. Mining companies reconsider hedging. Manufacturers evaluate forward coverage. Portfolio managers question broader asset repricing. Once those conversations enter executive suites, the phenomenon ceases being purely retail. It borders policy territory. It becomes macroeconomic. To keep this practical, here are personal guidelines for maintaining clarity amid turbulence. First, distinguish strong belief in an outcome from certainty about short-term path. You can hold a multi-year conviction while acknowledging daily uncertainty. Second, treat volatility as an inherent characteristic of this stage rather than a malfunction. Third, avoid allowing conviction to justify excessive size. The quickest route to ruin is holding the right view with an oversized, unsustainable position. Fourth, maintain awareness, not obsession, of key stress indicators: premium direction, spot futures divergences, expanding daily ranges, dollar trajectory, and central bank responses. When those indicators align, rapid moves become likely. They are aligning currently. For newcomers, resist the urge to act immediately out of fear of missing out. Markets repeatedly offer entry points. The genuine edge lies in preparation rather than reaction. Those destroyed in bull markets typically enter late, over-leveraged, driven by emotion. Avoid that pattern. Cultivate calm reasoning instead. For existing participants, don't allow short-term excitement to eclipse your original rationale. Scarcity, currency erosion, and industrial necessity form a multi-year theme. The journey will test conviction repeatedly, often convincingly, before resolution. Addressing the obvious concern: has silver detached from fundamentals into pure speculation? Momentum trading certainly contributes during vertical phases. That's standard behavior. Yet labeling the entire move speculative overlooks physical premium evidence, supply limitations, industrial requirements, currency dynamics, and historical role of gold and silver as stores of value predating modern banking systems. A simpler explanation fits. Silver is adjusting to structural changes that outpaced outdated pricing assumptions. For years, the market valued silver as a minor byproduct. Then global priorities shifted toward electrification, power infrastructure expansion, artificial intelligence systems, military modernization, and resilient supply networks, all amid policies that eroded trust in fiat stability. The resulting repricing appears violent because it shatters prior reference points. Ironically, that very violence draws sophisticated capital. Large participants pursue established trends in genuine scarcity rather than comfortable conditions. Evidence of institutional interest isn't anecdotal. It appears in price action itself: the size of advances, the rapidity of recoveries, the consistent buying on weakness. This is not encouragement to overcommit resources. It is encouragement to reason clearly. The single mechanism that resolves any supply-demand mismatch is price, not forecasts, not stories, not financial instruments, but price. Until price rises sufficiently to balance the equation, volatility persists. Monitor, therefore, key levels rather than daily news. Observe whether silver stabilizes above the major psychological threshold near $100. Consolidation there signals foundation building, not failure. Observe whether overseas physical premiums remain elevated. Persistence indicates sustained real demand. Observe whether extreme daily ranges begin narrowing post-spike. Compression can signal absorption. Observe the dollar. Continued weakness alongside firm metals strengthens the case. A major upcoming influence, the forthcoming central bank policy announcement. Current short-term rate targets sit approximately between 3.5 and 3.75%, with expectations favoring stability in the immediate decision. That context defines surprise. Stability, with neutral language, returns focus to growth and inflation trends. A marginally dovish tilt hints some future easing. Acknowledgement of softening data provides metals renewed support. A hawkish tone tests resilience. In authentic repricing environments, metals can advance despite restrictive rhetoric when markets perceive policy constraints. The deeper issue, does central bank authority still dominate metals pricing, or are metals highlighting the boundaries of that authority? That question defines the current contest. Regarding the dollar index, many view it as absolute strength, yet it functions as a relative measure against other currencies, each with unique challenges. Apparent dollar resilience on the index does not necessarily translate to strength in everyday purchasing terms. Notably, even without index lows of past eras, gold and silver have reached valuations that historically accompanied far weaker dollar readings. That mismatch points to supplementary forces: diversification of reserves, rising global appetite for tangible assets, and widespread skepticism toward paper-based commitments. Historical patterns offer precedent. Extended periods of gradual dollar depreciation in earlier cycles produced sustained metals rallies, not uninterrupted yearly gains, but clear directional bias as the unit of account diminished. Should similar multi-year dynamic reemerge, success will favor consistency over precise short-term prediction. Continuation, however, never proceeds calmly. Prepare mentally for corrections, sharp reversals, and recurring bubble-top declarations whenever the market pauses. Develop a structured approach. Ask yourself honestly, are decisions driven by emotion or by a reasoned position? In leveraged environments, individuals holding valid long-term views yet employing short-term borrowing frequently exit involuntarily. Margin mechanics disregard conviction. Two plausible near-term paths merit preparation. Path 1. Silver trades in a broad range above $100. Attention fades, enthusiasm cools, boredom sets in, then a breakout occurs swiftly during low visibility periods. Path 2. Silver experiences a severe retreat, expels participants, generates widespread told-you-so commentary, then surges again as physical demand reasserts and paper shorts cover. In both cases, the principle holds: markets penalize overconfidence, stay adaptable rather than dogmatic. Two questions for reflection. If silver fell $10 in a single session, would you react with panic or perspective? What evidence would cause you to reconsider your view on metals? Dollar recovery, rising real rates, or another factor? Now consider audience expansion. The precious metals discussion is escaping its specialized circle. You notice it when general finance commentators mention gold records matter-of-factly. You see broader outlets address tangible assets without hesitation. You observe overlap with cryptocurrency communities. This broadening does not automatically signal an imminent peak. It indicates transition from early adopter stage to wider curiosity. The late stage, universal participation, features different markers: casual mentions by non-experts, family members sharing strategies, pervasive mainstream enthusiasm. We remain short of that stage, but momentum is building. Acceleration often follows when price action supplies an undeniable narrative. To balance perspective, the primary risks include: first, unexpected policy tightening in response to inflation or currency concerns, which could exert temporary downward pressure. Second, broader liquidity stress in leveraged conditions where correlated selling occurs regardless of individual asset merit. Third, late-stage speculative overcrowding without deep commitment, sharpening corrections due to shallow holding. These hazards do not invalidate the underlying case, they define the character of the advance, and surviving that character separates participants. On the narrative side, watch sentiment extremes. Headlines proclaiming metals invincible often precede caution. Headlines declaring metals finished frequently precede opportunity. Superior results typically reward early entry and endurance rather than late enthusiasm. Avoid pursuing short-term price action. Pursue comprehension. One final observation before concluding. The next significant leg higher in silver will likely arrive on a day when confidence feels shattered rather than secure, when many conclude the move has ended. In such moments, avoid assuming defeat from paper weakness alone. Instead, evaluate, has physical premium evaporated or has paper simply panicked? If physical indicators hold firm amid paper selling, the market offers an important hint. If physical constraint intensifies alongside dollar softness, the setup favors extreme targets that skeptics dismiss. What seems extraordinary today will appear tame in hindsight should liquidity thin further. One last question for discussion. Which milestone arrives first, $200 silver or $6,000 gold? What single piece of evidence supports your view? This content aims to assist clear thinking about market dynamics. It does not constitute personalized financial guidance, nor does it recommend buying or selling any asset. Decisions rest with you, based on your own risk capacity, objectives, and circumstances.